Hey, you're a real estate investor and you want to avoid the audit grinder I see landlords walk into every year? Well, in this video, I'm going to show you the 7 red flags the IRS spots fast and exactly how you can clean your books and records so you can sleep better at night. All right, let's get started. Listen, bad bookkeeping isn't just a tax problem, right? Plaintiffs' lawyers will use sloppy books and records to pierce the veil of your entities. So what we want to make sure what we're doing is not only audit-proofing our books and creating better habits, because by doing so, we make sure that we reduce those risks of audits and we're protecting our entities at the same process. So what do I mean by audit proofing? Listen, you can go in, you can audit proof your books, and that doesn't mean that you're never going to get questioned by the IRS. But what it does mean is that if you are involved in an audit, you're going to come out on the other side looking a lot better. Now, there are several different things that the IRS tends to target that our tax department has identified in working with real estate investors. And so we're going to walk you through these right now, and I'm going to show you what you need to be doing to help to ensure that you're minimizing your personal risk when it comes to your books as a real estate investor. Okay, number one. Co-mingling and no separate accounts. Okay, so that goes without saying. You've probably heard this before. You've heard me in my other videos talk about this. Listen, if you're at Starbucks, right, and you've got a business card for your rental LLC, do you put that Starbucks coffee on your business card? Well, obviously, if you're there for business, the answer is yes, you could do that. But the problem is that let's assume that you're in Hawaii and it has anything to do with your residential real estate business LLC that has a rental property, and you whip out that card and you start charging all your Starbucks while you're there. You see, you can make a better claim while you're living in the state where your property is located that, oh yeah, I was looking at my property and I stopped up at Starbucks on the way to check out the property, but you can't make that same argument while you're in Hawaii. And so these types of things can cause an audit risk, especially when the IRS sees that you're spending a lot of money on food and beverage. So what we want to do is make sure we're not commingling, that is using our business card for personal expenditures. Because not only does it increase the risk of audit, it also opens up that argument to pierce the veil of your entity, and then you lose your asset protection. So how do you solve this problem? One dedicated bank account and card per LLC would work. Now, if you watch some of my videos, I told you that's not the only way you can do it, but if you're someone who has a hard time keeping track of expenses and has poor bookkeeping habits, then I suggest you create one bank account, one card per entity where you have your rental property. So then you know every charge, everything that goes into that one account is associated with those properties. Now, another thing you could do is create a property management entity. Now, this would negate the need to have separate accounts for each of your business entities. You could have one account up there at that property management level. But if you're doing that, then you want to make sure that you're creating a separate ledger for each of your individual properties. And so that means you want to use some type of management software, right? And then ensure that you have pictures of receipts or other things that you can do to document that this particular expense is associated with this property. Because there you're going to be doing all the work in one entity with different ledgered accounts, and you got to be able to track it back to the entity that owns the property. Okay, what is the second red flag that we see? Repairs versus improvements. Now, I was kind of torn whether or not I should put this as number one, but it is definitely a problem. Okay, so what do I mean by that? When it comes to improving your property or repairing your property, obviously we want to have repairs because repairs are deductible. Improvements are not. Improvements get capitalized. So think about painting, for instance. Well, painting is usually a repair, but adding brand new cabinets onto your property, well, that can be considered an improvement. And if you get this wrong and it gets picked up on your tax return, then that can create a problem for you and is most likely going to trigger an audit. So how do we go about fixing this problem? Well, number one, adopt a written capitalization policy, basically stating, listen, up to $2,500, it's always going to be a repair. You see, the IRS allows you to expense up to $2,500 per item, and it will qualify as a repair and you will not have to capitalize it. So if you're thinking about things, if you have a receipt for $2,500 or less at Home Depot, then that can automatically fall into the repair bucket if you were, say, adding some new cabinet doors onto a cabinet. So that's one thing. Another thing is to use routine maintenance and small taxpayer safe harbors if you're eligible for that. So this is something you should talk to your CPA about. That at the end of the year, when you get done, you have your receipts from the items that you'd spent money on for a particular property, figure out whether or not maybe you can fall within a safe harbor there, so you can just categorize it all as a repair and make it immediately deductible this year. Now, the last thing I would think is really important when it comes to this, in case you're audited, make sure you keep invoices, you have photos of those, and you have recorded dates of when you've actually done the work itself. And the reason why this is important is because if you ever get challenged as to whether or not you actually spent the money, you can prove when you spent it and what it was for. All right, red flag number 3. Missing 1099s and W-9s for the contractors, the people that you bring out to your property to work on it. Listen, if you're paying some guy to come out and you give him $2,800 and you use Zelle, right, to send him this money, then the IRS is going to expect a 1099 at the end of the year. Now, this is only, of course, required if they are not a corporation. But if you haven't gotten a W-2 from them, or excuse me, a W-9, then how are you going to send them a 1099 at the end of the year? Because that's what's required. By January 31st, you need to be sending in your 1099s for any individual that came out and worked on your property, any contractor that is not a corporation. So this is a low-hanging fruit issue for the IRS, where easily they can see you're expensing this out, but you're not providing any 1099s to back up who you're paying the money to. So the way you fix this, if anybody's going to come out to your property and you're going to be paying them money to work on your property, make sure you first collect a W-9 from them and then ensure you're 1099ing them after the end of the year. And of course, reconcile all this back to your bank statements. Okay, number 4. Okay, it's really simple to screw this one up. It happens all the time. That is auto travel and meals with no contemporaneous log. Listen, it's really easy to go out there and drive around and say, I'm going to take a mileage expense on my car and I'm going to write off all these miles, because that's a low-hanging fruit for you to take money out of your business completely tax-free. But if you're not keeping a log contemporaneous with when you're driving your car for work to look at your real estate, or if you're going out to lunch with maybe it's a real estate agent to talk about investing, or maybe it's an investor buddy, if you don't have these logs to back it up, that is how the IRS in audits have been able to disallow those types of deductions. Because essentially what they're going to do is say, all right, your memory 2 years later is not that great. So how do we know that if you're trying to recreate that log 2 years later, that it's accurate? The only way you can prove that a log was accurate is if the log was created when you incurred the expense. So what I'm telling you is that, hey, it's fine to go out there and drive and take a deduction when you're working on your property or you're going out for meals or other travel-related expenses, but you got to document what it was for and when it took place. And so what they look for is, when did you document it? At the end of the month, that's fine, but I think it's better at the end of the week or daily if you can do that. And so what you'd want to put in there, of course, is the mileage. What was it for? How far did you drive if you're using that? Maybe you're using a mileage app. Also keep itineraries, okay, and property-related agendas. If you're out driving around looking at potential deals, keep track of that, why you were doing it on that day. And then make sure you're always separating personal meals from business meals, and you have on there who was at the meal and what was its purpose. So what do I do personally on my business side? When I get done with a meal that is a business meal, A, I put it on my business card, B, I take a picture of it. But before I take that picture of the receipt, I put on the receipt who was there and what it was for. And then I provide this to my bookkeeper as our backup in the event we were potentially audited. Okay, red flag number 5, depreciation. Now, here's the thing. You can make errors in calculating out your depreciation, and this is going to trigger an audit. In fact, I'm surprised more people are not audited for this, because under the Internal Revenue Code, one of the things that you're required to do is actually audit the useful life of the asset itself. Most people put their residential real estate on straight line 27.5-year depreciation schedule. But as you know, if you've watched any of my other videos or several other videos on the internet, when it comes to cost segregation, a rental property is comprised of both 5 and 15-year property. 7-year property is basically devoted to commercial real estate. So what that means is that there are components of your asset that needs to be depreciated on an accelerated schedule, and you're required to do this. So many CPAs have just fallen into the standard practice of just putting everything on 27.5 years that they're missing out on a benefit for the property owner, but B, what is technically required under the code, that is depreciating an asset over its useful life. Now, where people are falling into audit risk here is when they use the wrong depreciation schedules for their property. That's going to trigger the audit. Now, what we like to do here at Anderson is if you're a residential real estate investor, we like to go out there and perform a cost segregation on your property. And depending on when you purchase it, maybe it's eligible for bonus depreciation. Now, in order to do that, you want to make sure that you're having the study performed by someone, a reputable company that will back that up in the event of an audit, and they'll provide you a breakdown as to how they reach their deduction for that particular property. Now, also make sure that when it comes to closing on properties, okay, you're always documenting your closing statements, your appraisals, you've got tax cards, your land allocation, that's really important as well. So if you bought a property for $500,000 and you're depreciating $495,000 of it, you're going to get audited because you can only depreciate the structure, not the land. So you have to be careful there. Sometimes what you can do here is if you want to put more value on the structure for depreciation purposes, maybe you work that out in the purchase and sale agreement with the seller, that the seller agrees that they're selling you the land at this amount and the structure at this amount. That could serve as a means in which you could back up why you reached the conclusion that you were depreciating a larger amount of that asset. Okay, so that's really important. All right, number 6. Passive losses offsetting W-2 income without reps or short-term rental status. Okay, so this is a big one for so many real estate investors. You hear about the benefits of owning rental real estate, that you can take the depreciation that exists beyond, after you've wiped out all your income from your property and all your expenses, and you have this loss sitting on your tax return on your Schedule E, and turn around and use it to offset your W-2 income. In fact, this is one of the greatest tax strategies for W-2 income earners, and that is buying investment real estate and turning it into a short-term rental, or having one of their having a spouse qualified for real estate professional status. Now, in order to do this, you have to be aware of what the tests require. So if you want to be able to take your depreciation and offset your W-2 income, and you want to be a real estate professional, then you need to document your time. Show that you spent 750 hours on real estate related activities, and it's 50% of your time throughout the year was in a real estate related field. That means you're not working a full-time job anywhere else. Now, if it's short-term rental, you need to show that your average rental period for that property was 7 days or less. Now, in addition to that, you also must prove that you materially participated in the activity. So that requires either you spent 100 hours on your investing activity, and that's more than anyone else, or the safe harbor of 500 hours across all your real estate that you own. Now, how do you go about and protect yourself here? Number 1, you want to make sure you keep, again, a log. Just like when it came down to driving around, meals and entertainment, this is really important if you want to qualify for reps or that short-term rental loophole. You need to document your time, all right, that you spend on real estate related activities, but more importantly, on the properties, what you did when you did it. Again, I've read multiple tax court cases where real estate investors have been denied this deduction because they did not have a log that was contemporaneous when they engaged in the activity on the property. So if you don't do that, you can expect a disallowance. So make sure you're keeping that log. Now, the other thing you want to do if you're a real estate investor here, if you're qualifying for reps, not short-term rentals, but for reps status, make sure you have an aggregation grouping election in effect. Now you're going to file Form 8582, and essentially what you're doing there is you're electing to treat all of your rental real estate activities as one activity. This is where real estate investors can again run into problems when they're trying to depreciate their property and offset their W-2 income. If you do not have this aggregation election in effect that has been filed with your tax return, then what the IRS will do is they'll say, did you spend 100 hours or 500 hours on each property, rather than looking at it in the aggregate. Now you can imagine what type of problems that would cause for someone. Now, if you're an investor who's doing both short-term and rep status, you need to call us, because now it gets even more complicated. I'm not going to go into it in this video, but just suffice to say you need to know these rules so you can maximize the benefit for yourself and reduce your risk of audit. So, number 7, and this just comes down to sloppy bookkeeping. That is where you have income mismatches with security deposits. All right, these are the errors that crop up when people are not paying attention to what it is they're doing. They have bank deposits, rent rolls, 1099s, miscellaneous, deposit ledgers, all this stuff comes together. And if you get audited, it doesn't make any sense. So you really need to track this. So unreported platforms can be an issue here, right? You know, Cash App rents, are they treating that money you're bringing in as income, or is it a refundable deposit? You have to keep a log of this, because if you're not, and the IRS looks at your account and they audit you, they may say, hey, that is actually income to you. So that's really important you're staying on top of this, maintaining the rent rolls and doing proper reconciliations with the bank deposits, okay, is key here. Sometimes it's better to do this. If you can do it, have a separate security deposit account. Put all your security deposits into one account. That way you segregate those out, and so there's no question that that money in that account is not income. It's not part of your rental income account. And so you just recognize the money that's in the rental income account and not the other account. So these are some of the problems that people run into when it comes to auditing as real estate investors, and they're really easily solved if you have a great bookkeeping team behind you. At Anderson, we have a phenomenal bookkeeping department. That's one of the things we encourage our clients to do, is work with them to make sure that we're monitoring this for you. So when it comes down to tax time, you're not throwing up any red flags onto your tax return that's going to get you audited. Also, what comes into that as well is how you set up your entities, which is equally important. Are those LLCs being set up as disregarded entities? Are you using a blocker partnership entity to flow the losses through, flow your income through? That can help you out immensely in decreasing your risk of audit as well. So listen, if you want to get a strategy session with someone here at Anderson, be sure to click on the strategy link inside of the show notes below. We got it there. We'll sit down with you. We'll walk through your structure, talk about some of the challenges you're facing. Maybe you want to then work with our tax department, our bookkeeping department, and we can work with you. I also have for you a landlord audit binder checklist. Okay, what this does is it walks you through the things, the issues that I was talking about. That is also available in the show notes below. Click on that, download it, go through it, and I wish you the very best with your real estate investing.